Hello guys and welcome to another video. My name's Mark, I'm an entrepreneur and property investor, and in today's video we're talking about why I believe investing in a single stock is akin to gambling and why I completely avoid it where I possibly can. And to be honest, if I look at my portfolio, I've completely avoided it. I only do index funds, and you could argue that one of the ETFs may well be a single stock because it's listed on the stock exchange. But let me explain the difference. Let me explain why I'm very, very keen on using ETF index funds over single stocks, and I'm going to use Tesla as a prime example. They are currently down basically 70%. It's a huge number. And if we look at the S&P 500, which are a constituent of, down 19% basically. So there's a big difference. But let's get into the video. Let's talk about why that is the case. And if you like this sort of content, if you like talking about investing, give this video a big like, and why not consider subscribing and take part in that ETF journey. We have our subscriber dividend portfolio where we invest in a big plethora of index funds, and every single month I put another £2,000 into it and I pay out the dividends to you guys. So let's get into why I believe investing in a single stock is akin to gambling. Well, in my opinion, you're basically investing in one company and one company's management structure, one industry potentially, certainly if you look at Tesla, and it's a very dangerous place to be. You're only looking at that single business. And there's been lots of examples of high profile businesses that have managed to go bankrupt, even constituents of the S&P 500 and constituents of the FTSE 100. I'm thinking of the Exxon crisis and I'm thinking of Carillion. Both went absolutely bankrupt, losing all their investors' money in a very short space of time with very little warning, and you weren't able to get out. Another high profile example would be Lehman Brothers, right? 2008, we all remember the high profile destruction of Lehman Brothers, an institution that it was felt was way too big to fail. Now, if you were a single investor in Lehman Brothers, you were wiped out. You lost everything. And I remember doing my boating license, in 2000 and I want to say 18. And I met a guy who was a director at RBS, and he told me that in 2008 he lost everything. He had all of his net worth tied up in stock options with RBS. And basically, as the management team, they was kind of not pressurized, but it was sort of expected that you would take as much stock as possible in the business you were running. And because of that, when RBS suffered their massive losses, they lost absolutely everything. So guys, that is the danger of having a single stock. It can go to zero. Now, if you contrast that maybe with the S&P 500, well, you've got the top 500 companies in America working for you. Now, we're UK, or I'm UK based. I'll use the FTSE 100 as an example. That's the 100 largest companies in terms of market cap in the UK at any one point in time. Now, let's fast forward. I know, for example, Shell is one of the largest. If we fast forward 50 years, let's say, for example, over those 50 years, Shell doesn't manage to amend what they're going to do, and I believe they will. I think they'll transition into a different business. But let's say they don't and oil stops being used, well, they might go down and become worthless. Now, if I was a single investor in Shell, I could lose everything. But because I own the index, as they become worth less, the index fund automatically sells down their position. As a different stock, maybe let's say, for example, Diageo do an amazing job and that becomes more valuable, it automatically buys more. So by doing that, we basically sell the losers, back the winners, and it's all done automatically. And there are lots and lots of data points on this. Of course, some people can hit a home run. Some people can get lucky. In the long run, there are very few people that can pick stocks correctly. That is statistically proven. Lots of data on that. I always recommend Unshakable by Tony Robbins, a great example of a book that tells you all about how index funds tend to be active managing and tend to beat single stocks. So over the long run, it's been proven time and time again, index funds tend to return better. And they've got low costs involved as well. If you buy an ETF, for example, I use Hargreaves Lansdown. The fees that HL charge me are capped at £45 a year for no matter how large my ISA portfolio is in ETFs. And my trading cost, because I buy every single month on subscription, my trading cost is only £1.95. So very low costs. When you look at the Vanguard costs, and let's look at the Vanguard FTSE 100 ETF, and let's have a look at what the cost base is. I bet you it's less than 0.1%. So I was right, the cost base comes in at 0.09% with a spread of 0.06. These are very, very small costs. And it's because there's no active manager there dealing with it. It is just a set of systems, a computer program, an algorithm that means that as different stocks become more valuable, it trades in and out to buy the more valuable ones, sell off the less valuable ones, and track the index. All the time you own the underlying asset, and that's the important part of these sort of investing. You still own the underlying asset, the businesses within it, the 100 largest companies, using the FTSE 100 as an example. Now the other benefit with Vanguard, for example, and I'm not sponsored, I'm not here to advise you on anything, I'm just talking about my personal experience, my personal preference, is with Vanguard, you also own Vanguard. So when you buy the fund, you own a part of the fund as well. It's done in the way that all the shareholders are essentially the fund owners. So it's done at the cheapest possible cost. And that was the legacy of Jack Bogle when he died, was that all of that would be put in place for people to get the lowest possible cost investments out there. So guys, that's why I use Vanguard, and also why I use HL, because the costs are so low. 0.45% up to a maximum of 10,000 on ETFs or shares, and then it's capped at £45 a year. I could have a portfolio in the many millions and it would still only cost me £45 a year to hold it on that platform. Very, very cheap, and the user experience is exceptional. So guys, let me know what your thoughts on this are. Have you invested in stocks without losing? Have you invested in stocks and lost? What's been your experience? Mine is that I have lost in the past. I've tried to pick winners. I accept today that I am not able to, and I'm just investing in index ETFs. What are your thoughts? Let me know in the comments, and I'll speak to you soon. Cheers, guys.